Welcome to Yahoo Finance Live. I'm Shauna Smith along with Akiko Fujita. Let's get you up to speed on the market action. We're looking at gains here across the board. The Dow up for the 7th trading day in a row, up just about 355 points. Some strong earnings reports helping drive today's action. We got solid results from Bank of America, Morgan Stanley, Charles Schwab, which is helping fuel today's gains. Also, Microsoft, a top performer in the Dow today, moving to the upside on some details on pricing surrounding its new corporate AI products. That's helping the tech sector more broadly. You're looking at the Nasdaq up just about 0.9%, Akiko.
Well, Shauna, as you said, shares of Bank of America seeing a pop today after reporting a very strong quarter. Bank of America beating Wall Street's expectations. Profits jumped 19% year over year to $7.4 billion and 88 cents on a per share basis. BofA's net interest income also rose 14%, meeting expectations at $14.29 billion. But it fell short of JP Morgan's 44% jump last week. For more on the bank's latest earnings, we're joined by Bank of America Chairman and CEO Brian Moynihan and Yahoo Finance's Executive Editor Brian Sazzi. Brian, take it away.
Thanks so much, Akiko. Brian, always great to get some time with you, especially on this earnings day. I was queuing into the earnings call, and the stock price, your stock price really got to move or push higher when you and the team started to talk about a higher or more, I would think, more upbeat outlook for net interest income this year. What gives you that confidence in that outlook?
Well, Brian, it's good to be here. And yes, Alistair Borthwick led the investors through the idea that we basically said that since last earnings call, we felt more comfortable that we'd have a better outlook for NII in the second half of the year than we did then. And that it'd be basically flattish quarter to quarter between 14.2 and 14.3, and then be above 14 in the fourth quarter. And that really comes from just the sheer power of our franchise, whether it's we're getting 4% annualized loan growth, which is good on the commercial side especially. We're seeing some card growth. We're seeing the deposits hang in there, even though, because we have such excess funding position, we're not competing for high cost deposits. We put those customers' money into the market and money funds and other things, and we actually even raise money from our customers for other banks to give them those rates because we don't have a use for the cash. And so even with all that going on, we feel good about the NII, and that's basically due to the power of our deposit franchise.
Is this outlook, Brian, your way of signaling to markets that this economy is going to see a soft landing from the various actions the Fed has taken?
Yeah, it's a little chicken and egg. We build our outlet based on the market expectation for rates. But let me back up, Brian, and talk about we have our research team led by Candace Browning-Platt that does tremendous work, and they basically have the first two quarters of 24 to be slightly recessionary, negative 1% GDP growth rate in the first quarter to 0.5% in the second quarter. So that's a pretty light recession at this point. And they've moved it out from this year into next year, and they've moved the duration to be shorter. So as you think about it, whether it's a soft landing, meaning it never goes negative or it goes slightly negative, I'm not sure people will feel the big difference. And what we're seeing in our customer base is the economy, the spending that goes on in our customer base, which is $4 trillion plus a year, which was growing at 10% a year for all the year 22 over 21, for example, has now slowed to 5%. And that 5% is very consistent with a low inflation, more normalized growth economy in the U.S., kind of what it was in 17 or 18 or 19. And that's good news, frankly, because that means the economy is getting back in line, even though we haven't had massive dislocation in employment, although employment markets are softer than they were a year ago at this time.
Are you surprised by this consumer resilience?
I'm not, honestly, and we've been saying this for a long time. This was going to be the Fed's hardest job, was to slow down the U.S. consumer, because at the end of the day, the amount of stimulus the consumer had, the fact that unemployment has run as low as 3.4%, the fact that wage growth, you see a lot of talk about what's caught back up to inflation, but if you go look at from the pandemic forward, the wage growth from 19, 20, 21 was very fast, and then it fell behind inflation, but cumulatively it's ahead of inflation. And so if people are working and they're getting paid more and they're spending, it's going to be hard to have a tough U.S. economy because of the amount that's driven by that. But on the other hand, you don't want them doing too much and feeling like they're getting behind on inflation, therefore demanding higher wages to get a wage inflation spiral. It looks like the Fed's was probably too late, and they said it themselves of getting in the game and raising rates. Then they finally moved very quickly, and they've caused that to slow down. And I think that's all good. But I'm not surprised by the resilience of the consumer, because when we looked at our customer data, you can go back and track us talking quarter after quarter. Our customers still have multiples in their accounts. Those same customers that were here in early 2020 today have multiples in their accounts than they did back then, especially in the lower balance accounts. And that's because they've spent some of the stimulus, but they've been earning money and they've been managing their finances well. That doesn't mean certain ones are having difficulties and layoffs are happening, but in a broad context, across 60 million customers, across $4 trillion of spending, it's a pretty resilient group.
Do you think consumer spending, Brian, will surprise to the upside later this year? We are now finally starting to see inflation slow pretty dramatically in this country. And looking at your results, to your point, you have a lot of people with a lot of money in savings and checking accounts that maybe they could get out there and spend in the back half of this year. How do you see it?
Well, if you think about the last few years, first it was good spending. They bought things because they're pent up in a house and they just had money and they bought stuff, and so they bought a new couch or a new grill or things like that. But you can only buy one of those. So then they started spending on what we called experiences, going out to eat, going out to movies, going on trips, and you still see travel's fairly strong, and you can see the bookings. I think all that, once people have done a lot of that, gotten a normal summer vacation in for their kids out of school, I think it'll sort of reach what it usually does. Is sort of 3, 4, 5% going faster than the rate of inflation, because the wealth of the country grows, and I think that's good. Now, the best news is that the credit worthiness of our customers is still extremely strong, and people keep talking. I get asked about, well, your credit card charge-off rate went up a little bit, or your 90-plus delinquencies went up some. But if you look at that number, it's still far below where it was in 19. And if you and I were having this conversation in 19, we'd be talking about 30 and 40-year record lows of credit costs in our company. And that's so we're normalizing to a very good place. And so I think that also means the consumer has some staying power, the equity in their home. And so, in the end of the day, if companies are making money and employing people, even though it's not as aggressive out there in the markets today on labor, people are going to have jobs and people are going to spend. But I think they're slowing down their activities because, frankly, if all they read about in the papers are going into recession, that kind of has an effect. And if things like a new car cost a lot more and interest rates, or a new home, mortgage rates above 7%, those slow down the activity. But that's what the Fed intended to do.
Yeah, Brian, I think this is the recession that everybody's been calling for a while. It just may not happen. But I want to go into commercial real estate. I looked at your results. When I see your results, I don't hear you calling out big negatives on commercial real estate. Why is that the case for a Bank of America, but a completely different story over at a company like Wells Fargo?
Well, I can't reflect on other people, but we disclose. It comes from what we call responsible growth. For a long time, we've looked at, in the commercial real estate business, to keep that as a percentage of our loans at a size in total, and even the office piece of that, to work with great sponsors of people in the buildings, great real estate owners, and then, frankly, make sure the terms are reasonable. And so as you look across time, that's served us well. So we only have about $18 billion outstanding in office properties, about a couple percent of our portfolio or less. We aggressively re-rate that based on the current conditions. At origination, it was a 50% loan to value. For all the reappraised stuff in the last 6 months, the average loan to value is only 80%. And so, yeah, there's stress going on in the system, but we underwrote, assuming that someday there would be stress. And the trends that have gone on about real estate optimization by companies, including our own, have been going on for a long time. It's just they've been changed a bit by the work from home and the 3-4 days a week and all that stuff. Just to give you an example, when we started with the management team in 2010, in our company, we had 130 million square feet that we utilized. Today, we utilize about 60. So this is a long-term trend of efficiency and use of office space that will continue. It just got pushed ahead by the work from home dynamics.
Do you share the concerns that some of your peers have on the outlook for commercial real estate?
I think, look, that's going to be building specific and city specific, and whether people work. And so, as we do a lot in New York, and you look down the street, you walk out on 6th Avenue outside a building, you get run over by people in town. In other areas, it's not the same. And then there's places, back and forth. And so you've read about San Francisco, a place like that. I think over time, these things will normalize. But I think what we have found so far is we lend to newer buildings and high quality buildings, and those tend to be doing better right now. But I guarantee you, the entrepreneurial spirit of America out there, when the right real estate values come up, people come in and reposition these assets like they've done for many times in the past.
Brian, you also called out something I think of great interest this earnings season for the banks, the potential for higher capital requirements. And I believe this was your stat. A 10% increase in capital requirements, if that does happen, might lead to $150 billion less in lending. That sounds to me like a big economic blow or potential economic blow.
Yeah, so I think just to simplify that, if you say that we're at 10% required capital and you go to 11%, that 1% doesn't sound a lot, but that's $16 billion capital, and then you multiply times 10 again, there's your $160 billion. And some people are saying, well, how can you get there? That's how you get there. So the reality is our lending capacity goes down. If you do this across the whole banking system, and that's why we're all awaiting these rules, but we hope that as the rules come out, they're balanced in terms of international competition. In other words, that right now, America and Europe appear to have the same rules, but they are advanced and we're in standardized. And if you listen, they're saying, well, we're going to go away from the models and all those things. That was the basis of Basel III, to get to advanced. So our advanced RWA are 1.4 trillion, our standardized are 1.6, so we have to use the higher under America's rules. That's not true in other locations. And so we have to be careful about keeping the balance and the competitiveness of the U.S. banking system, which is key not only to America, honestly, but it's key to the whole world, because the strength of our banking system actually helps the world prosper. The second thing then is the capacity inside the industry versus outside the industry. And so if you think about outside the industry, you have half the mortgage loans are done by non-banking companies. You have the new private capital funds being formed. Will those companies perform like we performed when the pandemic hit and $70 billion of loans came on our books in 3 weeks from our customers in demand? Will they be able to have that kind of shock absorber system? Will they be able to behave and absorb the turmoil that went on earlier this year? That's not clear to me. And the history has been paved with companies that have been in these businesses not been able to stand those shocks. So, I think that it's good for the banking system to have a lot of the economy running through it, but using the capital markets to lay that off and using the investor system to lay off, loan syndications and things like that. But if you make the capital rules so tight in banking, the stuff gets squeezed out. So remember, on an international basis, this is effectively a trade negotiation that's going on. If the rules are easier in mainland Europe than they are in the U.S., however you get there, whether standardized, advanced, or how you count the eggs and things like that, the reality is American companies will have a higher cost of borrowing versus European companies, of which they are engaged in the same competition and supply chain for large companies, or large companies would have the same costs. And so I think that's why we have to be careful with these rules. A, international competitiveness, and B, making sure that we keep the balance right of how we treat the U.S. economy. And I hope and I believe, and there'll be, in the aftermath of these rules, there'll be a lot of discussion about what are the pluses and minuses of these rules.
Well, Brian, before we let you go, you're plugged into the regulatory scene. Do you think regulators will overreach with these rules?
Well, I think I look back and the statements have been made by the chairs of the Fed on many occasions and by the vice chairs of supervision on many occasions, including in the Obama administration, the Trump administration, the current, that the capital industry was about right. And so we worry that, the idea of we need to have more capital is coming from, something that just says there's no downside to it, and that's what we try to raise the attention. But, in the end of the day, the rules will come out. There'll be a lot of discussion about them. There'll be a lot of understanding of what actually is in the rules. Right now, it's speculation. And I think we have to be balanced. You have to be balanced as a. I've been in CEO for this is my 14th year. I've been in banking my whole life. I've seen the wonderful things our industry does for America, and I've seen the downside of our industry. And matter of fact, the non-banking part of our industry, which was the heart of the financial crisis, those weren't banks, weren't under the same capital regimes, and basically are a proof point of why you got to make sure the stuff stays in the system. And so we've seen all that happen, and my colleagues have too. And we're saying, give us a fair set of rules that allow us to be competitive among ourselves with the non-bank providers and with Europe. And we'll deal with them, go on. But let's think this through from the broader prospects, not just more capital is better.
And investors, Brian, have seen a lot of steady, consistent, good results out of you and your team at Bank of America a lot of those years. We'll leave it there. Bank of America Chairman and CEO Brian Moynihan, always good to see you. Appreciate it.
Thank you, Brian.
Shauna, back to you.
All right, thanks so much to their That was a great interview. All right, let's talk about some of the movers. Bank of America, one of the standout stocks today, up just about 4%. But taking a look at the Dow, on track to close at a fresh 52-week high. And there are also several other stocks here poised for big gains. Closer look at the action. Jared Blickery is standing by on the big board. Jared, what are you looking at?
I am looking at a rally. Stocks on fire here. Nasdaq finally caught up. It started the day around in the red. It's up to 1%, matching the Dow's gain. This is the intraday look. You can see just barely climbing into the green before noon there. So impressive price action. You mentioned the Dow. Let me just show you what's going on with the Dow year to date. And you're going to see a big breakout candle today. I've been talking about on some of the morning shows how the transports have been surging recently. So this basically is confirmation of Dow theory. You got the transports and also the industrials making new highs. That's very bullish. Lots of stocks moving today. You mentioned Bank of America. All of these are some of the top gainers in the S&P 500. And I prepared a handy little chart just to give you a quick idea of how much we're talking about here. Microsoft with a 5.6 return, looking at a market cap gain of 143,000. Then NVIDIA, also a mega cap, up 2.5%, roughly half of that, only up 30 billion. I think investors will take that. United Health, Charles Schwab, Netflix. You take a look at some of these stocks and you just see that this rally is increasingly broadly based and really taking in a number of stragglers. Those are the sectors that have been left behind here. So I could go through some of these tickers, don't necessarily talk a lot of them here. Might as well chart Bank of America, just talking with Brian Moynihan, CEO, up to a 52-week high, or excuse me, not a 52-week high, but up to relative highs here. Finally climbing its way out of some of the banking troubles that we've seen. But you take a look at the regionals today, those are the ones that have really broken out. PNC, got to take a look at PNC. Impressive price action. This is a 2-year chart. Let me dial this down to a 2 months so we can see today's price action. Started out, I believe, in the red, basically climbed into the green off of a negative report. That is bullish price action right there. And I could go down the line. Charles Schwab up to its 200-day moving average. So just really tracking a lot of breakouts across the market. Do want to check in on the sector action before I go. Tech up 1.5%, followed by energy and financials. All of those outperforming. So you got the values and the cyclicals holding hands, marching higher. Shana.
Good news here for investors out there. Right, Jared Blickery, thanks. We are just getting started here on Yahoo Finance Live. Coming up, just a week out from the next FOMC meeting, and Wall Street almost unanimously predicting another rate hike. We're going to break down what the Fed might have in store for the U.S. economy next week. And earnings season rolls on with companies like Western Alliance and J.B. Hunt reporting after the bell. We'll break down those results as soon as they cross the wires. Stick around.
I always tell people that they should be maxing out their 401ks. And if you can't max it out, start somewhere. It doesn't matter if you start small and then you up it every single year, even 1%.
There's no question that the current economic environment we're in, with inflation running as hot as it's been for the last 2 years, has caused people to be in more of a pinch than maybe they were before.
There's two ways to really build significant wealth. One is through real estate, great investment, you get some tax advantages. Stocks are the other way. For most people, that's going to be the most viable way.
First, you've got to have savings. Second thing you want to do is really maximize your employer plan. You want to make sure you're getting the full match before you do anything else.
Let's do a check of the market sponsored by Tasty Trade. We're looking at 7th straight day of gains now for the Dow. Up roughly 370 points there. S&P 500 up 36 and the Nasdaq up 135. It is all about energy, financials, and tech today, the biggest movers, at least in the sectors on the day. Taking a look at the VIX, the fear gauge, we always like to monitor that one. Taking a look at where it is right now, up just slightly at 13.5.
All right, Akiko, you mentioned it, the market gains today. The Dow pushing higher, up 369 points, heading for the 7th straight day of gains. The market's digesting a number of positive quarterly results here from bigger banks. Bank of America, Morgan Stanley, Charles Schwab are the standouts today. Half of the companies in the S&P 500 that have reported earnings in the past week are in the financial sector, giving us a good glimpse at the consumer. This is according to FactSet. So let's talk a little bit more about the results we've seen so far. What it signals going forward. For that, we want to bring in Tom Hayes, Great Hill Capital Chairman and Managing Director. Tom, it's good to see you here. So the Q2 setup was similar to what we saw headed into the first quarter. Now that we've gotten even more results this morning from Bank of America, from Morgan Stanley, I guess what are your big takeaways just in terms of the health of the consumer and what it signals?
Better than expected. The bar was very low, and as we know, the secret to happiness in life is low expectations. So we came into Q1 negative 6.2% expectations. We got -2. Analysts had to take their numbers up. The strategists were looking for a drop of 20% in earnings. Instead, we got a rise. The same exact thing. We expected negative 7.1% coming into this earnings season. We're shooting the lights out. The average gain over the last 10 years during earnings season is plus 5.3%, which means we could finish up negative 1.7%, and that's going to force analysts to take their guidance up. And if we look at the next 2 quarters, even now the guidance is plus 0.1% for next quarter, so positive earnings next quarter, and then plus 7.6% for Q4. So a lot of good things coming, but I think they're coming right now.
Tom, give me a sense of what your read is on where we are in this economy right now, based on the numbers that we've gotten so far. I mean, you heard Brian Moynihan earlier saying, look, the consumer has been a lot more resilient than we expected. The economy is still fairly strong, even though things are starting to slow down. What's your read based on the earnings we've gotten so far in terms of where we're headed?
Well, you have an 80% beat rate, Akiko, and you have to keep in mind, people talk about negative money, M2 money supply growth. You had basically 10 years of money supply growth pumped into the economy in 24 months. So that's going to take a long time to work off. And I think that the pessimism is overdone. It's been overdone. Granted, we're up over 25% off the October lows, so we might have some consolidation. But that consolidation could actually look more like rotation. So while the indices may not quite do as well as they did in the first half of the year, being up mid-teens, maybe we'll get mid-single digits to high single digits. Underneath the surface and underneath some of the sectors that haven't participated, and we've talked about the Magnificent Seven, they've started to participate in the last 6 weeks since I've been on, which we talked about last time. That's where the opportunities are going to be. So if you're just jumping into the indices now, you may not be that excited to get 5 or 7 or 8%. But if you're jumping into the 90% that didn't participate the first 5 months of this year, there's huge opportunities. There are going to be stocks up 30, 50+%.
Tom, the beat rates that we've seen so far, is that enough, though, for the market's momentum, this rally, to stay intact? Or are we going to have to see maybe some stronger results elsewhere, economic data that's cooperating with a cooling economy, maybe for the Fed to back off in order to keep that trajectory to the upside?
Well, people were pretty pessimistic coming into the bank earnings. Other than the revenue was supposed to grow 7.8, which was going to be the highest, people worried about net interest income. That's proven to be better. I love what Brian Moynihan said about commercial real estate. People have been so pessimistic that this was going to blow up the economy. And instead, he's like, it's a building by building thing. It's going to work itself out. And these are going to be extended. They're going to be renegotiated. And it's going to depend on the different buildings. The A class are going to do exceptionally well. The B and C class properties, they'll work out and they'll restructure. So a lot of positive things happening. So I think the key is not being tempted with FOMO to chase the things that are up enormously already year to date and look at those things that haven't yet fully participated, because that's where all the money is going to come next. And actually, if we looked at the Bank of America Global Fund Manager survey this morning, it was so interesting. In the COVID lows in 2020, the institutions were so skeptical. After the market rallied from March till June, and it just took off, they still wouldn't get in the market. They were still pessimistic. They were still at high cash levels. Guess who bought those first 4 months? Retail investors got it right off the COVID lows, and it's the exact same thing is happening right now. The retail investors have been buying, the sentiment has gone up. Institutions actually picked up their cash levels this month. They're still overweight cash and bonds. They have the least risk on since the COVID lows and since the great financial crisis lows. Their growth expectations are still pessimistic. So that is further fuel for this market to churn higher on the indices level, but actually for the laggard groups, that's where they're going to have to chase. They're not going to chase what's up if they're already missing their benchmark. They're going to chase those things where there's opportunity.
Tom, we're a week out from the next FOMC meeting. When you think about expectations right now, nearly unanimous in terms of expecting a rate hike in July. Just under 3% think the Fed will hold to a pause. Based on the data that we have gotten since the last meeting, are you in that camp that this is the meeting where we have a hike, but maybe see a longer pause on the other end of that?
Well, Akiko, are you asking me what they should do or what they will do? Those are two different questions, but both are great questions.
What they should do.
What they should do is they should absolutely skip once again and say we're going to look at the data, because they have more than enough cover at this point to justify a skip. When you look at PPI, that was near deflationary levels, up 0.1%. That leads CPI. CPI was a tick off of a 2 handle, and we're still thinking about hiking rates. These things worked on a lagged basis. Between PPI and CPI, they have more than enough cover. You had the lowest job growth with the non-farm payrolls at 209,000 jobs created. You have the U6 unemployment rate at 6.8%. So the lagged effects of the tightening that have been going on for over a year are being felt. Now they just need to sit back and make sure that trend persists and make sure the data keeps going down. So if I was in Jay Powell's shoes, I would say skip, let's see more data, and ultimately turn into a pause. They probably won't do that because it's priced in. The market can handle another hike, but they shouldn't go too far beyond that, because when that lag kicks in, it tends to get aggressive. And right now they've landed this soft landing opportunity, and they could ruin it if they get too aggressive and too feisty.
So if they do 2 more hikes, the odds of a soft landing
go down materially.
How significantly?
Yeah, it's. I think you'd go down from a 95% possibility of a soft landing to maybe a coin flip.
The data that the Fed should be looking at, obviously inflation, CPI, core CPI, is what they're most closely watching. We've gotten to, on that headline number, not core CPI obviously, but that headline number, to 3%.
Yep.
If we want to see further cooling in inflation, how do we get that? How do we make more progress if the Fed is not going to continue to hike? Or they shouldn't, in your view?
We can't afford to see more disinflation because we have 120% debt to GDP. So the last time we had this much debt and debt service, as you saw the headlines, debt service is now approaching $1 trillion a year. That's huge. Last time we had debt to GDP at 120% was following World War II. And the way that they got out of it was through nominal growth. They let inflation run between 3 to 5% for 5 years. And debt to GDP collapsed from 120% down to 63% in just a handful of years. That's the playbook they should be following right now. Acknowledge that, continue to talk hawkish, we're going to take it down to 2%, but let it run a little hot so we can bring the debt to GDP down and have it at sustainable levels, have nominal growth run hot, and all will be well. So hopefully they're following that playbook and they're reading enough history books to continue. They've got a win here that, don't snatch defeat from the jaws of victory. They got a clear win here. skip it. If they won't skip it this month, then just go into a pause after this month would be great.
Tom, we started by talking about the banks. Financial is one area that has really benefited from the Fed's rate hike cycle, obviously because of the income earned on those rates. There's another area, though, that's been hit hard by the Fed's hiking, and that's REITs. I mean, what's your investment thesis around that right now?
Okay, so great question, Kiko. There are two themes that we're looking at now that the Fed is wrapping up. Whether they should have wrapped up at the last meeting, so they'll wrap up at this meeting. Number one, the dollar downtrend that began in October is going to continue, okay? So that's already happening. We had a short bid to safety in advance of the debt ceiling just a few weeks back. That's now rolled back over. So with the dollar weakening, we like multinationals that get up to 50% or more of their income from abroad. Those increased earnings are really not baked into future estimates. We're gonna start to see those come through in the second half of the year. We like emerging markets is gonna work with a weak dollar. Emerging markets, China, and risk on with biotech. Now, as it relates to REITs, the second theme besides weak dollar is that we're going to see the middle end of the curve to the long end of the curve, the 10-year, start to get bid, which will compress rates. That helps a number of things. That helps regional banks with their mark-to-markets. That helps REITs start to get bid because they're interest rate sensitive. And I know we were on a couple of months ago talking Vornado, and people looked at me like I had three heads, but they were kind and polite. And Vornado's up now 30, 40% since then because the high-quality businesses will do well. The B and C properties we're not so sure, but the A properties are going to do well. This is very similar to the mall crisis of 3, 4, 5 years ago, where everyone said all these malls are going out of business. The B and C properties did go out of business. The A properties, like Simon Property Group, that have Apple, that have Lululemon, did exceptionally well. We think it'll be the same case for commercial real estate REITs with A-class properties like Vornado, which we own.
Okay, Tom, stick around there because on the other side, we're going to talk a bit about your picks and some that you say to stay away from. Hint, generative AI and the hype around that. Going to be part of that thesis. We're going to continue that discussion on the other side.
Super.
Well, millions of Americans facing record high temperatures. We should say not just Americans, but those around the world. The sweltering heat, however, giving air conditioning related stocks a bit of a boost. Here are the details as Yahoo Finance's Inez Ferrer. Inez.
Yeah, Kiko, and those excessive heat warnings, the air quality warnings as well, that is giving AC stocks a boost. So let's take a look at some of them. I want to show you GE, which makes many products, but one of them also being air conditioners. They hit a 52-week high. That stock recently hit 52-week highs. Carrier, a heating, ventilation, and air conditioning provider, also hit a 52-week high, up 33% year to date. Lennox International, they make these smart thermostats for air quality, heating, cooling, also hitting a high. And Generac, that's a backup power provider, up 42% year to date. Generac recently received a price target raise at Piper Sandler. Look, these stocks are benefiting not just because we're in the heat of the summer right now and people are using their HVACs, et cetera. The HVAC market is expanding as individuals, as businesses try and consume less energy. They are upgrading to newer units, newer devices. And then you also have the tailwind of the Inflation Reduction Act, which passed last year. So a lot of people think of that act as, oh, EVs and solar panels. It's not just that. There were a lot of extensions on Energy Star tax rebates, which have been around for a while, but these were extended even more for individuals, for businesses, if they get new heat pumps, if they get new air conditioning units, et cetera. So that's what you're seeing with this momentum with these stocks.
Certainly benefiting from what's played out over the last couple of months. All right, Ines Ferre, thanks. Well, big banks coming out strong so far this earnings season. Bank of America shares trading higher, up just about 4%. The company beating on profits and revenue for its most recent quarter. Net income up 19% from a year ago. The bank is a top stock pick for our next guest. We want to bring back in Tom Hayes, Great Hill Capital Chairman and Managing Member. Tom, we just heard from Bank of America Chairman and CEO Brian Moynihan earlier in the hour telling us that he's not surprised about the fact that the consumer has been and will continue to be resilient. What's going to be the catalyst here for Bank of America? Is it the consumer from here on out?
I think it's a few things. I think expectations are very low, and I think the stock has already been derated. So Bank of America trades historically at about a 12.5 times multiple, below the S&P on average. It's now trading at about 8.8 times as of this morning. We bought this stock during the mini banking crisis in late March. We were looking in the rubble for dislocation, and we said when there's periods of dislocation, we benefit by buying the highest quality, and that's what Bank of America is, and that's certainly what Brian Moynihan is as the CEO for sure. So first off, it's been derated. It's trading at about 1 times book, which these stocks throughout a cycle can trade from 1 time at trough to 2 times at peak. So there's a lot of runway for the valuation re-rating. And I think generally the other thing that he didn't really talk about that they didn't touch on is they took their loan loss provisions were lower than expected this morning. Everyone thought it was a foregone conclusion they would have to take them up a little bit because people are so panicked about commercial real estate, about credit cards, and in fact, they took them lower than expected. So I think the quality of their business, the quality of their book is good. And as that 10-year gets bid, which we talked about before, all their mark-to-market with their loans, with their portfolio holdings are going to go up. So that's going to be an additional benefit for Bank of America. So it's best in class. We love it. We think Brian Moynihan is a tremendous leader. And, having seen how he worked the bank through the financial crisis, he and Jamie obviously are the best 2 in class. Yeah.
So that's kind of my natural follow-up here, Tom. You talk about B of A being best in class, but is this a play that maybe those who are watching can say, look, should I be looking at other financials too? How much of this is a B of A specific story? How much of this is about a second look, broader financials?
Yeah, so what we like to do is we buy high quality when it's on sale. So JP Morgan is high quality, but it's not quite as discounted as Bank of America is. We like it trading right around book. We like it trading at 8.8 times earnings. We like Brian Moynihan. However, the second, we did 3 financial plays during the mini crisis in March. One was Bank of America, one was Vornado, which we came on and talked about. Shauna remembers very well. And we also put on a trade with the KRE. We couldn't pick which small regional bank would do well, so we decided to buy the whole basket while it was dislocated, and that started to work out nicely. We think that's going to persist because As the 10-year gets bid, all the mark-to-markets on those banks are going to go up, and you're going to see a bid into small caps, which is 21% financials, and we think that group is going to continue to perform. So as it relates to the smaller banks, we like a basket. As it relates to the large money center banks, we like one pick, and that is Bank of America in terms of upside relative to price.
All right, Tom, let's switch industries just a bit. Talk about your next pick, and that's Cooper Standard, a stock that has actually done very well since the start of the year. Yeah. What's the bull case going forward? Okay, this is a little-known stock. We actually modeled this off of Charlie Munger. Did a similar trade during the recession of 2001. He bought a company called Tenneco. Tenneco had fallen from $16 down to $1. Cooper Standard during this recession had fallen from $146 in 2017, 2018 at peak auto production when they were earning $7.21 a share. They fell all the way down to $3.50. We initiated a position last May around $5.50. The bad news is it's up 3x, about 200%. The good news is we believe it's just getting started. Why do we think that? Because they were able to refinance their debt out to 2027, so that the solvency risk is off the table, which was a key factor. Stock doesn't go from 146 down to 350 if that's not a real risk. So they took care of that, and now auto production is starting to normalize, and we believe it's going to normalize. If it gets to 85 to 90% of 2017 levels, we believe this stock can earn $7, $8 a share again. Now, at its peak, it had a 20 times multiple on those $7. That's why it traded up to 140. Let's say it doesn't get a peak multiple again, and it gets to $7 of earnings power, and it trades at a trough multiple of 10 times. You still have a $70 stock. This stock is trading at $16.24 today. So yes, it's up a lot since we went public with it. And we think it's just getting started because all the risk is now out of the stock, and now you just wait quarter by quarter for margin improvement, and more importantly, because management is delivering. They can deliver. All you need to see is the industry volume production, and we saw it. General Motors sales were up 19% last quarter. Industry sales are up. We saw it a little bit in retail sales today. And you're going to see more and more incentives from the OEMs. So in a 7 or 8 or 9% environment, we think used cars are going to struggle, but when you're seeing it all over the TV, 0% APR, 0.9% APR, 1.9%. Before the pandemic, no one cared because money was free. Now that money has a significant cost, rather than buy the used car, you're going to buy the new car and get free financing, and that's going to do very well for Cooper Standard, which provides all the sealing systems around the windows and glass, fuel, brake delivery systems, fluid transfer systems, all to the new car producers. So we're pretty excited about this, and we're going to ride the wave in a leveraged way for the pent-up demand because the average car on the road is 13.7 years old, so people need new cars.
Tom, let's talk about some stocks that you're not as excited about. Okay. Apple at one of those that you've picked out. Is this a valuation issue? Because this is, Apple is one of those sort of those steady stocks, right? Is this just about the run-up that we have seen in tech overall?
Yeah, so these are two of the greatest businesses in the world. So, we're not shorting these stocks. Our base case is that we're going to continue to see a rotation in the second half where the stocks that ran up the most in the first half are going to perform less well. It doesn't mean they're going to crash. It doesn't even mean they're going to go down. It means that they're going to underperform relative to the catch-up trade, some of the groups we talked about, financials, small caps, et cetera. When you look at Apple, though, objectively, they're growing earnings. Their long-term earnings growth rate for the next 5 years is expected to be about 7.9%. They're trading at 32 times earnings. Now, you can say, well, it's the greatest company. They should have a premium. Yes, they should have a premium. But over the last decade, most of the time they traded, their multiple was in the low teens because they had the low earnings growth rate. And that implies a 3 times price to earnings growth rate PEG ratio, which is a little rich. So all we're saying here is for new money, we wouldn't be chasing this stock. We would certainly be strongly considering it if it came down at a lower price, but you may never get that big discount. We're just saying underperformance for the second half on this front.
Tom, I'm guessing you're going to have a similar stance as to why you're not liking NVIDIA, given the price evaluation and the massive run-up that we've seen over the last several months. Well, look, again, NVIDIA is a great business and going to continue to do well as a business, and they're growing earnings actually at 21% long-term expected growth rate. So the 59 times PE is slightly more justified.
But at 24 times sales, I literally just can't stomach it. Maybe I'm old-fashioned, but I can find better things to do. I look for, very simple businesses that I can understand for doubles and triples over a reasonable amount of time, 12 to 24 to 36 months. And I'll leave the shiny new objects for others to discern. But great business, just a little too rich for my blood.
And those who got in early are certainly having the last laugh now with that massive run-up since the start of the year, over 200%. All right, Tom Hayes, always great to have you. Thanks.
Thanks for having me.
Coming up, earnings season rolls on. Tesla set to report second quarter earnings after the closing bell on Wednesday. What 3 things you need to watch out for? We got that for you next. Tesla gearing up for second quarter earnings tomorrow after the bell. The stock skyrocketing more than 55% in the last 3 months. Here with the top things to watch, we want to bring in Yahoo Finance's Pras Subramanian. Pras, you got your eye on 3 things that we need to be looking for in this report tomorrow. What are they?
Yeah, so 3 things I'm watching here, and analysts, of course, is first off, gross margin trough, the Cybertruck, and also expansion of the factory. So let's start off with the margin trough here. So a lot of analysts believe that this quarter might be the low point in terms of Tesla's margin, which have been the envy of the industry. They hit around 19% automotive gross margin last quarter. So people expected to dip again in Q2, but then possibly rise later in the year. Hopefully, for investors, they'll hear whether Tesla indicates that is the case. Secondly, Cybertruck. So over the weekend, we saw that Tesla tweeted out a picture of that Cybertruck, and that first one produced out of the Giga Austin facility. That's a big deal because Tesla was sort of 2 years late in bringing that truck on. But right now, it seems like they are actually starting to produce in low quantities. Let's see what they say in the earnings statement and possibly in the call after. Is this just a pre-verification build? Is this truck actually going to be delivered to a customer? We'll see about that. And finally, expansion, right? So Tesla here, they probably have around 2 million, 2.5 million of vehicle capacity right now. They want to hit 20 million by the end of the decade. That's going to mean more factories. So Tesla's been talking recently. We've seen them in France and India talking about expansion there, or just doing some sort of operational activity there. And then also, the Journal reported yesterday that Tesla wants to expand Giga Berlin by double, to increase that capacity by double. So we'll hopefully hear more about their long-term plans on how they plan to build up to 20 million vehicles by the end of the decade.
Pras, going back to the Cybertruck, I mean, yes, there's a lot of excitement around this delivery event that's supposed to happen this fall, but the initial announcement was made back in 2019, right? Did I get my years right? 2019. If you think about where the EV truck competition is right now, who are they going for? Who's likely to go for the Tesla? How can they compete when other competitors have already come online with their cars?
That's a really good question. I think that the Cybertruck kind of occupies its own space in between the F-150 Lightning, which is a work truck, and something of an adventure truck, mostly a work truck type of everyday kind of vehicle. And then the Rivian, which is purely, in my opinion, hardcore adventure people going out, overlanding, camping, all that stuff that coastal types of people will do. I think that Cybertruck occupies that middle ground where it can actually be used for both work truck type of activities, but also lifestyle and sort of the adventure travel set there. I think that's where the Tesla kind of Cybertruck occupies that space. And we saw Ford sort of reacting here maybe to the news that Tesla was bringing out this Cybertruck in possibly limited fashion this quarter with those deep price cuts of the F-150 Lightning just yesterday. I'm not saying that's because of that, but it could be. It's not coincidental that both of these things happened in the last 2 days.
Yeah, the competition certainly is heating up in the electric pickup space. I'm with Akiko, though. I don't know who the heck is going to be buying this Cybertruck. I'm not sold. I feel like the design's just way too futuristic for me, but we'll see. There's always people out there that are willing to buy these things. All right, Pras Supermanian, thanks.
Well, the return to office movement picking up steam. A new report says more than 1 million office workers have already faced mandates so far this year to return to the office. Another million are expected to face more requirements in the second half of 2023. Our next guest says the U.S. office market is taking its first steps toward recovery. Joining us now is John Gates, JLL America's Market CEO. John, good to talk to you today. My question to you is, how do you define a recovery? When you consider how depressed the office market has been, how slow it has been to come back, what would a recovery look like?
A return really to equilibrium and healthy market dynamics, I would say. And we are getting closer. The thing about the recovery is it's been very, very methodical, right? On a monthly or quarterly basis. Then we've had some cyclical challenges impact that as well. The secular change where every office worker almost in the world went home in a span of 2 weeks was wildly abrupt, unprecedented, sort of in economic history. So it's been very methodical, but we do see positive signs in the data.
John, do you think we're going to get back to those pre-pandemic levels? And when you talk about the timeline of that, what does that then look like?
We're a couple of years into it, and I think it's perhaps another year. You all just cited the data where there's been actually closer to 1.5 million office workers have had company policies change to return to office for portions of the time, and another 1 million yet to come this year. That's a lot of space, 2.5 million workers, and they're going to occupy at least 100 million square feet, at least a couple of days a week, just as an example. That's a very healthy metric, and it helps get closer to stabilized equilibrium markets, as I said.
You've pointed to leasing activity picking up. What are some of these companies seeking? I mean, we have heard anecdotes about offices, businesses, for example, considering short-term leases because, yes, they want employees to come back, but they don't know how many will come back. They don't want to go for the long-term leases that maybe would have persisted before the pandemic. What are you seeing?
We're seeing just about everything you could imagine. Business people are creative, and so somewhat shorter term space, almost universally new and highly amenitized space. So the absorption figures and the leasing figures for office buildings that were delivered in 2015 or more recently have been actually pretty healthy the last couple of years. It's the older product that's not as shiny, it's not new, and it's not as highly amenitized unless it's been completely redone, where they've really lost a lot of tenant base. Some do want shorter terms. As you know, commercial real estate assets are the capital stack is long-term capital, so there's only so much room for shorter-term income streams around those assets. So some of that gets done, and then a lot of times, if you want to be in the right building, you're going to sign a lease that might be 7 years or 10 years or even longer.
John, who is signing these leases? Can you point to a specific sector where you're seeing the most activity, or are you seeing industries across the board bring their employees back?
Both. I mean, you tend to see surges in industry sectors, right, to your point. So in Q1, financials had a pretty big surge. In Q2, energy and utilities have had a pretty good surge. There's a nice, in the scheme of the overall market, it's a little bit of a blip, but it won't surprise you that we're tracking over 1.5 million square feet of requirements for new artificial intelligence companies, and about half of that is in the immediate San Francisco area. So we see all industries methodically recovering, but yes, in any given quarter, you absolutely see an industry surge.
There is, of course, a big question about what that commercial real estate future can look like with debt payments, and whether those debt payments can be made. We spoke to Bank of America CEO Brian Moynihan earlier today. Take a listen to what he had to say about his outlook on that.
Look, that's going to be building specific and city specific, and whether people work. And so, as we do a lot in New York, and you look down the street, you walk out on 6th Avenue outside a building, you get run over by people in town. In other areas, it's not the same. And then there's places, back and forth. And so you've read about San Francisco, a place like that. I think over time, these things will normalize. But I think what we have found so far is we lend to newer buildings and high quality buildings, and those tend to be doing better right now. But I guarantee you, the entrepreneurial spirit of America out there, when the right real estate values come up, people come in and reposition these assets like they've done for many times in the past.
So he talked about sort of the newer buildings, those that are being more creative, and that's kind of what you just mentioned, John, earlier about your outlook on that. But are there particular cities that you think will be especially slow for years to come?
Yeah, I mean, Brian said it very well. It's very individual asset driven, right? Commercial real estate is very asset specific. You've heard of the sunny side of the street in retail. So different cities and different submarkets are recovering at different paces for sure. The age of the building is a very significant factor. The submarket it's in a given market or city is definitely a factor. And then you have a combination of the secular change in the use of space, but also sometimes, you have debt maturities. That's a relatively small percentage of the overall market, but we're in an environment where capital is very expensive, and debt obviously is probably pretty close to peak interest rates. So if you had a maturity right now, it's a lot harder to refinance it than it would have been a year ago. That's absolutely true. So there is a percentage of the market where you're looking at all of those factors and saying this individual asset may be owned at a basis that might not make sense in the current environment, but it's certainly not an overwhelming broad thematic that's out there. It's a very fixed percentage of the overall market, I'd say.
JL's John Gates, it's good to talk to you today. Really appreciate the time.
Thank you for having me.
Well, coming up, the closing bell on Wall Street, we're going to check in on the latest market moves and the top trending pickers. Stay tuned.
And that closes out today's trading action. All three of the major averages ending the day in positive territory. The Dow up just about 366 points. Among the top performers there, Microsoft. We're going to talk a little bit more about the announcement they made regarding pricing for its AI corporate products in just a bit. The S&P up about 0.7%. The Nasdaq up about the same amount as well. This market check sponsored by Tasty Trade. Let's take a look at some of the individual movers of today's action. We got to start with the banks. Bank of America, Morgan Stanley, both of those banks rising to the upside today on upbeat earnings results. You're looking at gains for Bank of America up just about 4.5%. Morgan Stanley closing up just over 6%. When it comes to Bank of America here at Kiko, very solid results from the bank. Net income up 19% from a year ago. Revenue rising 11%. We heard from their CEO, Brian Moynihan, last hour. He was very optimistic, listing out a number of reasons to be optimistic about his banks. And you can make the argument more broadly for the larger banks here for the second half of the year.
Yeah, best first half revenue in a decade. And certainly we heard from Brian Moynihan pointing to the optimism, at least going into the second half of the year. You know, it was interesting to me, Shauna, how much he talked about the consumer and the strength that he has been seeing there. Talked about it this morning, saying that he, despite the slower economy, consumers remain strong. And earlier in that conversation with our Brian Sazi, saying, even when you look at delinquencies, that's still below the 2019 levels. That points to the fact that consumers are still doing well. Yes, they don't necessarily have the kind of savings that they had at the height of the pandemic because of some of the funds they were getting in, but it's still not depleted, in that there is still a lot of spending that is going on that front too. So Bank of America, obviously more consumer facing than some of the other big banks. And it sounds like at least Brian Moynihan feels like that could be a big benefit moving forward. Shares of Pinterest ending the day higher, up after an upgrade from Evercore ISI analyst Mark Mahaney, citing several reasons for the upgrade, including the stabilizing ad market. Specifically, Shauna here, you talked about the signs of digital ad spending, the strength they're going into the second half of the year, but he also talked about the turnaround that Pinterest has been seeing under new CEO Bill Ready, and that a lot of those changes he's made are starting to take hold.
Yeah, and this is the first time we see Mark Mahaney bullish on Pinterest in just over 2 years. His new price target here for the stock is a street high. So certainly turned the corner. At least he thinks Pinterest has turned the corner with some of its troubles. We know Pinterest has lagged many of its social media peers in terms of the gains that they have seen since the start of the year. But Mahaney making the point that he's seeing some strength within the digital ad market, saying that there is a distinct probability of material revenue growth acceleration, also substantial margin expansion over the next 2 to 4 quarters. We know that Pinterest has had a very tough several months. They announced some restructuring, layoffs, closing offices. So with all the changes that they have made, and also with the fact that the ad market, at least in Mahaney's view, stabilizing just a bit, he thinks Pinterest is certainly set up for future success here and well positioned going forward in the remainder of the year. Let's also take a look at Chipotle, because that stock on the move today, trading higher, up just about 1%. The restaurant chain had some big news. It's expanding its stores here into the Middle East, into Kuwait and Dubai. We know of 2 locations right now, but the big reason as to why I think analysts are bullish about this announcement is because it's first foray into the franchise model. So they're expanding into the Middle East. They're doing this through its first ever franchise partner. So what that signals in terms of maybe future locations in the area certainly has a number of analysts excited.
Yeah, I mean, you have to wonder, the Middle East may be the first stop, but how many other opportunities there are, particularly in market like Asia, for example, if they are moving forward on that franchise model. Interesting point to make here, Shauna, in terms of the franchise owner, the franchise group they are working with. They are already in on the biggest U.S. names. That includes Starbucks, Shake Shack, as well as American Eagle Outfitters. So certainly in good hands, it sounds like. But it's going to be interesting to see how they do, at least in that market, or at least in those 2 markets they're pushing into.
Yeah, certainly. Wells Fargo was bullish on this announcement. They raised their price target to $2,400, maintaining their overweight rating. So they're seeing upside of about 12% from the current levels. All right, let's take a look at housing. The number of available homes for sale falling to the lowest level we have ever seen. Yahoo Finance's Danny Romero joining us now for more on what we're seeing in terms of inventory and really just the lack of homes for sale right now.
Buyers are feeling the pinch, Shauna, right now. About 1% of previously owned homes sold during the first half this year. Buyers have fewer options than they did even before the pandemic. The shortage of homes has also pushed up home prices. The median home price right now is clocking in at about $426,000 in June. So why is there the lack of homes? Well, many homeowners are sitting on a lower rate right now. So there's really not an incentive to jump on another home or list their home, especially now that mortgage rates are hovering around that 7%. Some experts say that mortgage rates could go back down closer to that 5%, and that will drive up demand, also help with affordability, those monthly payments. At the same time, experts aren't expecting that mortgage rates to dial back down as the Fed plans to hike up rates. The chatter on Wall Street, though, is that mortgage rates could be sitting around 6% by the end of the year, Shauna.
So that might get some more homes at least on the market, but still, like you said, a lot of people locked into those lower rates and they're not going anywhere, at least for now. Right, Danny? Thanks. Coming up next, the race for AI dominance heating up after Microsoft announcing its newest AI tool, its Bing Chat Enterprise. We're going to break down how the company's software is pushing Microsoft ahead in the AI wars. That's next.
Microsoft's Inspire 2023 conference kicking off today with a look at the latest Microsoft Cloud and generative AI innovations. Shares of Microsoft jumping on the heels of a big announcement, or we should say some big announcements, including the pricing for its AI subscription service. Joining the conversation, Microsoft Corporate Vice President and Consumer Chief Marketing Officer Yusuf Mehdi, along with our very own Dan Halley. Dan.
That's right, Akiko, and welcome, Yusuf. I kind of want to kick things off first with the pricing for Microsoft 365 Copilot. This is part of the reason why we're seeing shares of Microsoft jump this afternoon. And, you know, $30 per user per month. It's pricier than we've seen for other Microsoft offerings. Can you just walk us through the decision-making process there and why that price and what that provides to users?
Sure, Dan. Yeah, and just from the start, today is a huge day for generative AI to now be used at work. And I think that's the big thing, which is that up until today, there's been a lot of excitement about AI, but it's not used in the workplace because people are worried about their confidential data leaking out. Today, we made two big announcements to help with that. One is Bing Chat Enterprise, which we can talk about in a second. And the other, as you mentioned, is the Microsoft 365 Copilot pricing. The way I think about it is we have a good, better, best offering for customers. There's Bing as you know it, and we've been able to use today. It's free for everybody. Then there's Bing Chat Enterprise, which is free if you're a Microsoft 365 subscriber, and we'll have a standalone price of $5 if you're not. And then finally, Microsoft 365 Copilot, which gives you the ability to reason over all of your data, use it natively within your Microsoft Office apps, and do some pretty unique things like get Teams summaries from Teams meetings. We've been in pilot. We've gotten great feedback on the value, and that's what led to the pricing.
And so, you know, when it comes to these two products, Microsoft 365 Copilot, that basically allows users to get access to both the web version of Bing, but then also pull in their own information from you know, their own databases at their company. So I think one example that's been tossed around is if you're a healthcare provider and you're trying to look for a healthcare plan, or a customer is trying to look for a healthcare plan, they'd be able to reason over that quickly using the AI capabilities. Is that kind of accurate?
Yeah, that's right. And so you can do the scenario you just talked about, Dan, in Bing Chat Enterprise for free if you're an M365 customer. So you can, for example, let's say you're building that confidential health device and you want to use AI to help you create the proposal and create the strategy. You can enter now that confidential specifications about the device, get data from the web, compare the two, help it build your strategy, help it write your documents, and be confident that none of that data is going out into the AI system. It's not training the models. No one looks at that data. And that you can get today with Bing Chat Enterprise. And then Microsoft 365 Copilot takes it to another level because you can now just point the AI to any of your documents, PowerPoints or Word or Excel, and have it automatically work for you.
So, you know, we have obviously a lot of talk of AI over the past half year. You'd say, you know, obviously you guys launched in February with Bing and the new version of Edge. What kind of uptake are we seeing? You know, is this something where customers are continually asking about Microsoft's products? I mean, you have it across, you know, obviously 365. You have the standard Bing. There's multiple permutations of AI going on here. Are customers kind of like rushing out to Microsoft to say we want more? Are they tepid? What's the response kind of been?
Yeah, it's a great question, Dan. I'd say it's a couple of things. First off, there is tremendously broad excitement for the power of AI and what to do. And so we've gotten lots of inbound demand for it. The actual, what we think of as product market fit, as you talk about in the tech world, I would say we've found that with a class of people and a class of scenarios, people who are writing code, people who are writing long documents, doing strategy and analysis and creativity. For those use cases and for people who do that, that has taken off. For the general public, I think they're still trying it. They're still learning how to use it better. And that's why today's announcement is such a big deal, because those use cases that are working are really what people do at work. And that's why I think today we're going to see that, because companies have been clamoring to want to use this generative AI at work, but they've had to actually ban it for legitimate concerns about their data privacy. Those all go away starting today.
And what are those concerns when it comes to the data privacy? Or what are they outside if you're not using Bing Enterprise Chat?
So there's a couple things. First is there's a concern that if you do a chat or a private search, as we said, that your data goes outside the org boundary. The second is there any commingling of user data with web data? That doesn't happen. The third is the data that's being used, is that actually being used to train an AI so that someone else goes and uses AI, start to learn from your data? And then the last thing is, hey, are the chats saved? Are they stored? All those things are protected with Bing Chat Enterprise. And so you can essentially chat and search with confidence that none of that data is going out, none of it's training AI models, none of it's stored, no Microsoft person looks at your data. It's all completely private.
And then I just want to ask you, obviously you're not a fortune teller, unless you are, in which case I'd like to know the Powerball numbers. But guessing that you're not, where do you see this kind of AI capability continuing to go? Where are we going to see it start to bubble up next?
Well, we're such an exciting time right now. I think we're going to see this AI world explode. Like we said, today is the unlock for everyone at work to now start using chat to be more creative, to be more productive at work. We think that's going to really fly. We talked a lot last month at Build about plugins. This is for third-party companies to come in and then add on top of the chat. So you can get legal advice, you can get shopping help, you can get travel help within the chat service. So if you're an individual user and you're saying, hey, help me proofread this legal document, you can call those. I think that will take off. And then as we get to Copilot, to have it in the natural flow of your work, just as you're within PowerPoint or you're within Teams, and you can say, what did I miss in this meeting? What action items did I get if I wasn't at a particular meeting? What's the most important thing I should be working on this week? All of those capabilities in Microsoft 365 Copilot, all of that will happen. So I think you're going to see an acceleration of how AI really empowers you to be essentially a super user, a power user, whether you're in Windows or any of our Microsoft software applications.
All right, Microsoft Corporate Vice President and Chief Consumer Marketing Officer, Yusuf Mehdi, thank you so much for joining us.
Thank you, Dan.
And Kiko, back to you.
All right, Dan, thanks so much for bringing us that conversation. We should mention Microsoft stock ending the day at a record high, looking right now, closing the day up about 4% there. And we got a number of analyst calls, Shauna, or at least weighing in on those announcements that Yusuf Mehdi that was just talking about. One specifically coming from Dan Ives over at Wedbush. He's already got a $375 price target, outperform. But he said, as a result of the pricing around AI, the total addressable cloud AI market opportunity for Microsoft could increase cloud revenue annually by 20% by 2025. So already a significant boost coming out of that. And then you add Microsoft Copilot onto that. And we've certainly got some bullish calls on that too, in terms of the potential.
Yeah, Kiko, I was calling this a game changer here for Microsoft going forward. We saw a lot of excitement, not only from Dan Ives, but really from a number of analysts across the street. The stock was up over 6% in intraday trading. Barclays, another name here, weighing in, saying that the pricing news is a major step for Microsoft's AI monetization. Also calling out that it was at the upper hand in terms of expectations, a view that we also heard from Brent Thill as well over at Jefferies. But when it comes to Barclays, and similar to that revenue upside, Barclays saying that the revenue derived from these tools could be substantial, assuming that high adoption rate. So there's a lot of excitement around this right now, what it could mean for AI, or what it could mean, for Microsoft in a couple of years down the road, but very, very dependent on that adoption rate and how quickly businesses adopt AI. If you're judging at all based on the excitement that we've seen over the last several months, I think it's a safe bet to say that companies will adopt these types of products at a very, very fast rate.
Yeah, and because of Microsoft's ecosystem, the expectations, they've already got this sort of built-in, right? Built-in, I don't know if you want to call it loyalty, but the user base is already there. And to Yusuf Mehdi's point there, when you think about how something like ChatGPT, for example, is being utilized right now, a lot of that is within the office space. So it's going to be interesting, not just from a revenue perspective, Shauna. I'm curious from a use case perspective, what we learn as a result of this too. And certainly, I'm sure we'll be getting a lot more from Microsoft.
We certainly will be. But again, huge gains that we saw in the stock today did hit a record intraday high in earlier trading. All right, well, the Biden administration announcing today a labeling program for smart devices focused on cybersecurity. You'll soon be seeing these labels on products from Amazon, Best Buy, and Google. Yahoo Finance senior tech reporter Ali Garfinkel is here with the details. Ali.
Hi, Shauna. So these labels are going to be called the U.S. Cyber Trust Mark. And the goal really is to help consumers choose products that are less likely to be subject to a cyber attack. Now, what kind of products are we really talking about here? It's everything that is connected to the internet in any way, shape, or form that's on the table. Fitness trackers, refrigerators, speakers. And the companies that are involved are some of the biggest companies that we cover here on Yahoo Finance, some of the biggest companies that are making a lot of these smart devices. Think LG, Amazon, Best Buy, and of course, Google. Now, this is actually so new that the FCC today is actually applying for that trademark. And the implication is that over time, we're going to be seeing more and more of these labels on more and more devices, especially as consumers become acquainted with it.
Ali, why do you think the Biden administration is finally teaming up with some of those big tech names?
It's a good question, Akiko. I think it's a combination of increased risk and increased awareness. In terms of increased risk, I think it's especially important because that's something they're seeing at a national security level. Let's think about last week, for example. Microsoft helped reveal that Chinese state-linked hackers were breaching emails at the Commerce and State Departments. That was big news. At the same time, at this point, there are more than 5 billion people on the internet globally in some capacity. And that combined with the AI boom, there's really an awareness of cybersecurity. I don't remember the last time I've had so many people asking me, is this cyber product safe? So I would say that, the White House historically, Congress, the government has historically been quite slow on tech issues. And I think this is in part is an effort for that to really change.
Okay, Ali Garfinkel bringing us the very latest there on that front. Thanks so much for that. Well, let's do a check of the markets sponsored by Tasty Trade. All three major indices closing firmly in the green today. The Dow, they're notching its 7th straight day of gains, up 366 at the close. The S&P 500 up 32 and the Nasdaq up 108. Coming up, our Yahoo Finance team is diving into some of today's top trending stories. Ali Canal and Josh Schaefer are standing by with what's on deck. Guys?
Well, Chipotle is looking to expand its footprint, and that's helping boost the stock price.
And some of those burritos might be headed to a place you haven't seen them before, and maybe even outside the U.S. We'll have where next. Welcome back to Yahoo Finance. Josh Schaefer here with Alexandra Canal and Pras Subramanian, breaking down some of our favorite trending stories of the day. And guys, I want to start with Chipotle closing at an all-time high today off a new partnership that they're going to be expanding into the Middle East. So this will be the first time that Chipotle is actually allowing franchisees, someone else is going to be operating these Chipotle restaurants, not Chipotle itself, expanding into the Middle East. There's been a big push for when will Chipotle bring more locations, right? Always wondering when there's going to be more locations. They currently have about 3,200 in the U.S. Also, I should note a Wall Street Journal article out today about Chipotle expanding in the U.S. and getting into more rural areas. So overall, the story of the day, Chipotle expansion and franchisees. Seems like investors seem to like it today, stock up a little bit. But I think interesting to think about Chipotle beyond the scope of the U.S. and how just massive that opportunity would be when you think about how successful it has been for other fast food or fast casual chains to be outside the U.S.
Yeah, and like look at the full screen right now, international portfolio. I mean, there is a lot of room to run here overseas. And I think of Starbucks, for example, and how anywhere you go, you can find a Starbucks. And I think for Chipotle, which is a company that's pretty mature, has a lot of wins under its belt, that is the next phase of growth, is just trying to expand as much as possible, both here in the U.S. for those more rural areas, but also internationally as well. So I think that's going to unlock a lot of growth.
And the group that's operating this, I believe it's called the El Shaya Group, also operates the Starbucks in the Middle East and Shake Shack and Texas Roadhouse. So they're going to have similar operations there that have been successful too, which seems bullish overall.
Right. You know, you look at that full screen we just had, that's only 50 locations out of 3,200 that are outside the U.S. And that's just Canada and Europe. So I think the Middle East is a great area for them, for poised for growth. A young population there, growing population there. They're talking about that group, that franchisee company, working with Chipotle directly with the supply chain, so they keep that their fresh sort of vibe going on with that supply chain. So it's sort of a good partnership there. Use a franchisee to do that. Don't go in there because they own and operate all their stores in America. That's gonna be hard to do in the Middle East. So I think it's a smart move by them. And I mean, 50 out of 3,200 international. I mean, that's poised for growth big time.
I think it's crazy too to think about the opportunity that also being discussed in the U.S. to just be in more rural areas. It'd be interesting to see what the business is like. I think a lot of times we think about Chipotle now as like, at least here in New York City, office lunch, right? Or something like that, foot traffic. Curious when you go into more rural areas and you're basically probably wanting people to go for dinner, right? After work. How does that play out? Does that sort of translate to the same kind of demand? I was just looking at maps. It's interesting to see some areas that I know I've spent some time in where there just isn't a Chipotle and there's other fast food options that seem to be busy. Like Northern Michigan comes to example, a pretty remote area, but popular, has fast food, just doesn't have Chipotle. Do they go to an area like that? Do they go up there? I think it's interesting.
Makes me wonder about supply chain again, right? Can you get those fresh ingredients in, let's say, middle of Idaho or someplace in Ohio or something like that? Maybe Ohio's not a good example, but I think it's kind of hard to get those fresher type of the guacamole, the chicken, the whatever, to these places, perhaps.
Right. Well, one of my favorite things whenever I travel abroad is to go to the McDonald's and see what new offerings there are specific to that country. And I feel like that's potentially an opportunity if they're going to go in the Middle East. You could create some pretty fun
the Burger King cheese sandwich, right? That's the thing, right? Isn't it Burger King with the 20 slices of cheese in between bread right now that they're offering somewhere?
Because it's true, the tastes are different depending on where you go. So I don't know, I'm excited.
I heard, they said that they're going to tailor the experience for local audiences for Chipotle in the Middle East too. So anyway, stick with international. I'm looking at the airlines here, in particular United, expanding their Asian service here to Manila, Tokyo, and Taipei. New services there, adding from San Francisco and also LA. A big international sort of move for them. As you know, we've seen a lot of other airlines sort of expanding international operations as the revenge travel trend continues. So United says that, including this Pacific service, they have 114 international cities across the Atlantic that they service, and that they anticipate that their Asian service will grow by 40% over what it had pre-pandemic. So these are big expansions of the business internationally for not just United, but the Deltas and the other airlines of the world, the Americans. So Josh, I know you're following these airlines. We saw Delta with a nice strong quarter there, but the stock prices aren't exactly moving, right?
Yeah, we were talking about it a little bit earlier. It's just always interesting to see what investor reaction is like to something like that. You take a look at a Delta chart over the last 5 days. It really hasn't moved that much considering the fact that they beat on the top and bottom line, raised their guidance for the year. We know when you take a look at TSA checks right now, basically things are 2019 level or better. Yeah, and you see the bump up today, obviously you saw though. So it'll be interesting to see once all of these airlines report too, once you get United and American later this week, then what is the sentiment on travel? Are we then feeling a little bit better about demand if they all say they're feeling better about demand? Or are some of these issues that you're seeing playing out at the airports? I mean, it was just last weekend, we had people in the office that couldn't get back. You're reading about it all over all the front page headlines, right? People are struggling to travel right now because of all the different pain areas that still seem to exist in these airports as far as it being more fluid. And I wonder if that's part of the headwind here too.
The worker shortage, the pilot shortage, all of that plays into these flights and whether or not they're able to get off the ground. I have a friend who's stuck in Nantucket. Feel so bad for her, but because her flight was canceled at the very last minute, and that's just something that you're hearing more and more anecdotally. But just to look at the year-to-date charts there, the recovery story has been pretty significant, right? I mean, just under 50% for Delta, United Airlines, American Air on the year. And considering where we were at one point with the pandemic, all of the headwinds that these airlines have faced, I do think they are poised for more growth in the back half of the year, and perhaps investors will jump on board. And I think this will be a key earnings season for all the airlines to really convince those investors.
Just real quick, Josh, we talked about this earlier. You mentioned that these huge run-ups this year, but they're still not where they were at 2019 level, right? So the question is, are these businesses sort of discounted because that they're rocky, they can get hit at any time, any kind of mini pandemic knocks those stocks down. These airlines are not necessarily going to go bankrupt because they're important to the economy, but at the same time, the discount there, maybe it never gets back to where a valuation, you're never going to get a good valuation for an airline because of the fact that the business model is just so razor thin. It's a tough business to be in, and that's sort of why maybe they just sort of lag there.
Yeah, 5-year chart is crazy.
Delta stock's at about $48 today. It was about $58 in early 2020 prior to the pandemic. And I do think, Pras, it's just you're seeing it more with these labor shortages and things now, like what happened to Southwest over Christmas. It just gets extrapolated, right? When you get put in a tough position where you're sort of already squeezed, then weather can impact your business. I think we're just learning it's a little bit more volatile than maybe some people want to participate in.
Well, we're going to keep tracking the airlines. More than likely, you're probably paying a little more for a flight, and you're paying more for streaming services. This is a tale as old as time that we've been hearing over and over again. Late Monday, Comcast announcing that they'll be upping the prices of their Peacock subscription service for the first time ever. Remember, Peacock launched in 2020, the summer of 2020, so this is the first price increase that we'll be seeing. We'll see the monthly fee go up by $1 to $5.99 for the ad-supported plan, $2 to hit $11.99 for the mostly ad-free Peacock Premium Plus tier. But guys, this is something that we've seen across the board as all of these streaming giants are trying to lessen those losses. The only profitable streaming company out there is Netflix, which reports earnings tomorrow. That company, I think they're going to beat pretty significantly across the board. Analysts have remained incredibly bullish on those revenue initiatives like the password sharing crackdown, the ad tier that they recently rolled out. But other than Netflix, there's a lot of competition out there.
I'm just sort of spitballing here, right? I feel like Netflix is sort of like the Tesla of the EV world because they're the one company that's making the EVs and making money. Other automakers are trying to do EVs and they can't make any money. But anyway, back to Netflix.
Sure, that's a good comparison.
First mover's advantage.
Right. I guess you're right. Back to Netflix. Tomorrow we're going to hear about those numbers, and I'm curious to see, Ali, if we're going to mention anything with the pipeline being affected by the actor strike, the director, or the writer strike, and then also what's the effect of how much growth is in the ad business, right?
I think that tells you a lot about pricing too, right? When you start to introduce that ad, Netflix's ad tier is what, $9.99 if you pay for it on your own, $6.99 if you pay for it on your own. That's an interesting value prop now, right? For someone that maybe wasn't going to get into it. Then you also have the passwords coming out. So I'm just curious, what the appetite is for people to keep paying $6.99 right now. You have Peacock going up to $5.99. There's no chance I would pay $5.99 for Peacock. I don't think they have any original content, right? That's what Netflix does well.
Tour de France.
And has done well. Right, but that's not their own original content is my point. They don't create a lot that makes you want to have that. Maybe you want it for a period of time, like when the Olympics are on, you get a Peacock subscription for a month, and then you unsubscribe. And I think that's what Netflix has been good about, and it'll be interesting to hear what they say about that writer strike and how that impacts their original content creation moving forward, and if it's going to.
I think they will definitely talk about the writer strike. However, we've heard multiple reports, Moody's was out with one recently, that Netflix is best positioned to weather a prolonged strike due to the fact that they have a large amount of content, right? They heavily rely on overseas content as well. Consumers have gotten more used to dubbing technology. We're more accustomed to watching subtitles. So out of all the media giants out there, Netflix is well positioned for this strike. So, and when it comes to the negotiating table, they're not going to be the first studio to come out there and say, yeah, let's work on a deal, because really they could weather this storm for a bit.
And isn't it what everyone's fighting over? Streaming profits, right?
Mm-hmm. Yep. Money talks at the end of the day, as they always say.
That's going to do it for us over here at the round table, but you'll have more Yahoo Finance on the other side.
More than a week after labor talks broke down, contract issues between UPS and the Teamsters union remain at a standstill. The two sides blamed each other while workers threatened to walk off the job. Back in 1997, a 16-day strike led to a 98% drop in operating profit, according to UPS SEC filings. Yahoo Finance's Jared Blickery sat down with New York Times opinion writer Peter Coy and Stanford University professor of political science and Center on Democracy, Margaret Levy, to discuss what lies ahead for UPS amid its ongoing battle with Teamsters.
Well, first of all, what the American public is now getting is a little bit of lesson in the way in which unions negotiate and the employers negotiate with them. We haven't had a lot of major union actions for some time in this country. So it's very hard to know what's going to happen in this, but I suspect that a lot of what is happening is signaling that each are really solidifying their position, and there's very likely to be another round at the bargaining table before an actual strike takes place. If the strike does happen, it's a big one, a really big one. There are 340,000 workers. This affects our logistics chain, our supply chain, how we get our packages. We're all incredibly dependent on that these days. There is an alternative, of course, two alternatives in delivery, FedEx and the Postal Service, neither of which would be striking. FedEx, both of them, because they're under a totally different set of regulations and rules, not necessarily because their workers feel that they're any better off.
Yes, important point there, and we can come back to that in a minute. Peter, first, I wanted to get your big picture thoughts on this, please.
Right. This is vital for both sides. As the professor mentioned, there are 340,000 Teamsters working for UPS. So they're absolutely indispensable to UPS's function. On the other hand, the UPS accounts for 1/3 of the members of the Teamsters. So the union needs the company to succeed as well. And a piece I wrote that came out just after the breakdown in negotiations for my newsletter in the opinion section of the New York Times said that it really would be a shame if there's a strike here, because they've had a long and productive relationship. Teamsters Union goes back to 1903, UPS goes back to 1907, and they have had a mostly productive relationship ever since then, where the pay is relatively strong, the working conditions are relatively good, versus, say, FedEx, for example, or for Amazon. And they're so close now. Several of the critical issues have been resolved. For example, refrigeration and other cooling methods in the trucks, which was a very legitimate bargaining condition for the Teamsters. They got that. Elimination of a second tier of pay for certain part-time worker drivers, they got rid of that. What remains now is negotiation over pay, and that has not been resolved. And the clock is ticking. I work for the opinion section, so I'm allowed to express an opinion. I'm not going to take sides in the talks, except I do think that it really would be a shame if they did not manage to reach a contract and we had a strike.
Fair enough. Won't hold you or force that. Margaret, you mentioned a couple minutes ago the organization. So FedEx is organized under a different set of laws than UPS. We can throw Amazon into the mix. People wonder, well, why not Amazon? Can you just kind of give us the lay of the land here with respect to how these things are shaped with respect to the law?
Well, there's a set of legal regulations that affect the right to engage in collective bargaining and the conditions under which unions can strike. And there are two principal sets, and they really have different rules. The one that affects UPS is the National Labor Relations Act, which was passed in the 1930s under Franklin Delano Roosevelt, and which is really, as is the Railway Act, which was passed even before that and is what FedEx is under. They're both very decaying pieces of regulation. They were built for another era and another time, and yet they're what these unions have to, and the employers have to struggle with. But they are very different. So the Railway Act, which affects FedEx, does not permit this kind of bargaining and strike under these kinds of conditions. So FedEx keeps saying, look, we're so much better off because as an employer for you to deal with because our workers can't strike. On the other hand, their workers are much worse off in many, many ways, as Peter Coy just mentioned. And so it's very important that UPS and the Teamsters come together on this and continue the progress that they've made. One of the big things here that I really want to emphasize is this two-tier system that was introduced and has been introduced all over the place by employers, in which new workers are brought in under different and worse terms, worse payment, worse benefits. UPS has been better than most in how it has implemented that two-tier system, but the two-tier system has been a real stickler. And even though the negotiations have now somewhat ended it, there are still pieces of it that remain in place, and I do think that's part of what's holding up the bargaining as well as the wages.
Peter, in your article, the opinion article that you were just talking about, you say a UPS strike would harm the company, the union, and the customers. You're very clear that this has wide-ranging implications. Given what Margaret was just saying, is it possible, do we just need new labor laws? Is that a potential solution here?
I want to go back to something Professor Levy said about the different treatment of the two unions or two companies. FedEx, for historical reasons, the express portion of their business is treated under the Railway Labor Act, which makes it hard to strike and also hard to organize, which is one reason that FedEx Express still not organized. UPS under the National Labor Relations Act, it's easier to organize. And yet the historical differences between the two companies have shrunk so that it kind of doesn't make sense anymore that they're treated differently. And that's been a sticking point for years for UPS, the management, saying, we feel that FedEx should be treated the same way we are. And when you talk about the harm of a strike, to me, it's analogous to the harm from a war. Two sides talks between them break down. They go to war. The war ends inconclusively. Lots of suffering has occurred. And then you end up with a deal that could have been struck without a war. A strike can be the same way. The idea that one side is going to convincingly win the strike is just ridiculous. What will happen is we'll just have a strike, a lot of interruption to the economy, the workers' strike fund guaranteed to run out, the company will lose money, business will go to competitors such as UPS, and then a deal will eventually be struck with a lot more ill will and lasting damage to both sides. That's not that different from what could have been reached now before the strike deadline.
Margaret, can I say, though, that the threat of a strike is a very important tool?
I was going to give you the last word here, so please go.
Yeah, I mean, even though I agree with you, Peter, about the effects often, not always, but often of a strike, the threat is an incredibly important. What else do workers have? If they're organizing and have collective bargaining, then they have to be able to threaten to withdraw their work and have it be a credible threat. Otherwise, they have no bargaining power. And that's what's going on here.
Fair point.
All right. Peter, actually, we got one more minute. Any last words from you?
No, I think that Professor Levy just made an excellent point. And by saying what I said, I wasn't trying to say that the union shouldn't use whatever leverage it has. Both sides are appropriately using the leverage they have as we reach the final weeks. I guess what I'm saying is that let's hope that this game of chicken doesn't end up going off the cliff, that in fact they do soon, I hope, reach a contract. The problem is that the union has said that it won't do, it'll go on strike if there's not a completely ratified contract by then, and there's not time for that. So I hope that the union would say, okay, fine, we have a deal. Even though it hasn't been completely ratified, we're not going to walk off the job until voting is completed.
I think there's been some change in that, Peter. I'm not sure. I think the union has agreed to
that's sensible, yeah.
Plenty to debate there. That was our very own Jared Blickery, along with New York Times writer Peter Coy and Stanford University professor Margaret Levy. All right, time for some after-hours movers. Shauna's watching that for us.
All right.
Shauna.
Kiko, we've got 4 stocks for you here. Western Alliance, Carvana, JB Hunt, and Interactive Brokers. So lots of movement on the screen, and most of actually all of it tied in some regard to earnings. Let's start with Western Alliance, the regional bank that was caught up in the turmoil that we saw play out within the regional banking sector earlier this year. That's off about 5% here on its earnings results. Now deposits, that was one of the key data points within this report that actually beat the street's expectations, totaling $51 billion, but they did miss a net interest margin. They also missed a net interest income. One of the reasons here that we're seeing so much pressure in extended trading. Net interest income coming in at $550 million. The estimate was for $579 million, so a bit short there. We're looking at a drop of just about 6%. Let's move on to Carvana. A bit of news after the close today, and that stock off just about 10%. We're going to get quarterly results from Carvana before the bell tomorrow morning, and this is a stock that has certainly been caught up with the mean trade. It's been a favorite here among investors, at least as of late. We have seen pretty significant gains in Carvana stock. But remember, lots of questions just about what the future of this company is going to look like, what their need, how much money they're going to need to raise in order to remain within business here and also steer the company in the right direction. JP Morgan was recently out with a note in just the last week, I believe, saying that they believe the stock is going to fall just over 70% here from the current levels, given all of the concern around Carvana's business model. So those are results you're going to want to keep an eye on tomorrow. Let's flip over to J.B. Hunt, the trucking company. That's under pressure, off just about 1%. Revenue missed expectations, declining 18% on a year-over-year basis. The trucking revenue, that segment, that was off 29%. Last mile delivery was off about 13%. The company saying that higher wages, also equipment maintenance expenses, that also weighed on their margins during the most recent quarter. So we're seeing some pressure on shares there. Interactive Broker is the last company here to roll through. They released quarterly results. That's off just about 2%. It's a good look. It's a trading platform here, and it also gives us a good look at the retail investor, what they are doing right now, and what that activity looks like. Well, EPS coming up a bit short. That missed expectations. Revenue as well, but it did reach $1 billion, up significantly than what compared to the levels that we saw just about a year ago. Total customer accounts up 19% on a year-over-year basis, coming in at 2.29 million. That, though, was slightly below what the street was looking for. So as a result, we're seeing some pressure on shares here in extended trading. All right, well, coming up next, it's closing time here on Yahoo Finance. We will recap the top stories of the day and also get you set for everything you need to know ahead of the open tomorrow. Stick around.
I always tell people that they should be maxing out their 401ks. And if you can't max it out, start somewhere. It doesn't matter if you start small and then you up it every single year, even 1%.
There's no question that the current economic environment we're in, with inflation running as hot as it's been for the last 2 years, has caused people to be in more of a pinch than maybe they were before.
There's two ways to really build significant wealth. One is through real estate, great investment. You get some tax advantages. Stocks are the other way. For most people, that's going to be the most viable way.
First, you've got to have savings. Second thing you want to do is really maximize your employer plan. You want to make sure you're getting the full match before you do anything else.
It is closing time here at Yahoo Finance. Here's a look at some of the top stories of the day. Former President Donald Trump is facing the possibility of a second federal indictment in connection with efforts to overturn the results of the 2020 election. Trump posting on Truth Social that he received a letter from special counsel Jack Smith. This is possibly the clearest sign yet he could face those charges heading into the 2024 race. Despite legal headwinds, Trump is still leading in the polls. Banks in focus on Wall Street on the heels of earnings from Bank of America and Morgan Stanley. Bank of America beating on the top and bottom lines, telling our own Brian Sozzi earlier that the consumer is resilient. Meantime, Morgan Stanley shares jumping after better than expected second quarter results. Executives offering an upbeat outlook for deal-making activity. And finally, Microsoft shares closing at a record high. The company revealing pricing for its AI subscription service. The Copilot service adds artificial intelligence to Microsoft's suite of Office products, which will cost an additional $30 a month.
It's time now to take a look at what we are watching tomorrow. Investors expecting a slew of big name results, starting with Goldman Sachs. The bank set to report earnings before the bell after what has largely been a positive earnings season so far for the sector. The pressure, though, is on Goldman Sachs CEO David Solomon, as the bank is expected to post its worst quarterly earnings results in years tomorrow. And looking to after the closing bell, investors will get the latest read on Tesla's performance with the EV maker's second quarter results. The company coming off a string of good news here for Tesla, including charging deal, strong delivery numbers, along with the build of its first Cybertruck. The stock has seen gains of over 55% in just the last 3 months. And the earnings season keeps on rolling on. Netflix also reporting after the bell, with analysts expecting subscription gains from the streaming giant's crackdown on password sharing. Investors will also be closely watching for any insight on the implications from the writers and actors strikes. And Oddity Tech is expected to go public tomorrow in an IPO market that's showing some signs of life. The beauty and wellness company has yet to price the offering, but it did raise its proposed price range to $32 to $34 a share. Well, that does it for us today on Yahoo Finance. Thanks so much for tuning in. We'll see you right back here again tomorrow afternoon, 3 p.m. Eastern Time. Have a good night.